Hey guys, today's question comes from Mary in Fort Worth, Texas. Mary asks, we're considering selling our company, which is an S corporation. Is it better to structure the sale as an asset sale or a stock sale? We've heard conflicting viewpoints and want to make sure we make the right decision. Well, hey Mary, thanks so much for reaching out and thanks for the question. Selling a company is a very important decision. So you need to make sure that you're working with a great CPA and a great lawyer to make sure that everything is structured properly and there's no surprises when you go to closing. Mary asked her question through our website, askacpa.co. If you have a question like Mary, head over to our website and drop us a question. If it hasn't already been asked before, we'll create a video or a written response on our website. Now let's jump into Mary's question. So when it comes to a stock sale versus an asset sale, the seller typically prefers a stock sale. With this method, we take the sales price less your cost basis in the stock, and that's your gain. The gain is a long-term capital gain, which can be taxed at either 0%, 15%, or 20%. But in the year a business is sold, it's typically going to be at that higher 20% tax rate. So now let's look at an asset sale. So with an asset sale, it's a little more complicated. We would take your asset listing and assign a purchase price allocation to each asset. Any asset that is valued greater than the tax basis will be subject to depreciation recapture and capital gains tax. For example, if you purchased a truck for, say, $50,000, the truck was fully depreciated in the asset, so you have zero tax basis, but it's valued at, say, $60,000 at the purchase price allocation, you'd first have a $50,000 depreciation recapture and then a $10,000 in capital gains. Depreciation recapture is going to be taxed at a 25% tax rate, while your capital gains will be taxed again at 20%. We would also value any hot assets, which are like accounts receivable, which would be taxed at your ordinary income tax rate. The purchase price that is greater than the asset value would be considered Goodwill, and that would be taxed at your long-term capital gain rates of 20%. Goodwill is typically going to make up the largest part of your allocation. So which is better? It depends on your situation and the asset's values, but typically stock sales are more favorable to the seller. From the buyer standpoint, they generally prefer an asset sale. The buyer wants to protect themselves from any potential litigation from issues arising while they were not the owners. In a stock sale, the new owners could be liable for any past mistakes of the business. When there is a stock sale of an S corporation, the buyer will make what's called a 338H10 election, which allows them to treat the transaction like an asset purchase. Additionally, stock sales into S corporations will often result in a restructure because S corporations can only be owned by individuals in certain trusts. If an LLC or a corporation purchases an S-corp, it's going to bust the S election and default back to either an LLC or an S-corp. Hope this quick video helps explain the difference between a stock sale and an asset sale of an S corporation. If you have any additional questions, check the link below for a more detailed explanation on our website. Thanks so much for watching, and we'll see you in the next video. Take care.